Good afternoon, everybody. Thank you so much for making the time to join us for Market Sense. I'm Heather Hedges with Fidelity. So we have now had our first Fed rate cut of the year, and the Fed signaled two more cuts may be on the table before the end of 2025. And by the end of last week, stocks were notching fresh all-time highs. Rate cuts are also a good thing for the corporate earnings outlook. And we've also seen some upward revisions to earnings estimates recently. So things are looking up with the stock market. But another development that we are watching is Congress is moving closer now to the potential for a government shutdown. It could happen a week from tomorrow. So that is something that we are monitoring for you. And if there were to be a shutdown, we would focus on that on next week's Market Sense. So we're going to be diving into all of these developments today and, of course, talking about what it might mean for investors. And we are delighted, as always, to be joined today by Jurrien Timmer. He is Fidelity's Director of Global Macro. Plus, we also want to welcome back to the show Jake Weinstein. He is here today to talk about the Fed's cut and what it might mean for the economy and for investors. He's a Senior Vice President here on Fidelity's Asset Allocation Research Team, or ART, as we like to call them in-house. Jake, so good to see you.
Great. Thanks for having me. Happy to be here.
Welcome back to the show, Jake. Nice to see you both.
Nice to see you as well. And today is Tuesday, September 23rd. And Jurrien, let's talk about these markets that just won't quit. So we saw all three major stock indexes make a sort of, I guess you could call it a financial hat trick if you're a hockey fan. The Dow, the NASDAQ, the S&P reached new highs last week following the Fed rate cut. We even saw new highs with the Russell 2000, of course, which tracks small caps. That hasn't happened in 4 years. So sort of a big deal here. Let's talk about what's happening here. And, I think investors might be wondering, given the headlines that they're seeing these days, and given the fact that there tends to be seasonal volatility this time of year, where is that seasonal volatility? What's going on? Does this market, it continues to, surprise our greatest expectations? Do you think it's still going to keep going?
Well, so the thing about the seasonals, which tend to be weak from August through the first half of October, the caveat always is that the market is weak then, all else being equal. And of course, all else is never equal, and especially not equal in 2025. So what the market is running on right now is very positive earnings momentum, an economy that's doing pretty well, some of the jobs data notwithstanding. And we're seeing upward earnings revisions. We're seeing margins go higher. Obviously, the Mag 7 AI story is still very much alive. And so the market has positive momentum, and it actually has spread to the rest of the world. So non-U.S. stocks are participating now in what has become a global bull market, as we are about to mark the third anniversary of this bull market that started back in October of 2022.
All right, a global bull market, but still here at home, while we're in a bull market, one question that is looming right now that we're seeing in the headlines, as I mentioned at the top of the show, Jurrien, is this potential for a government shutdown on October 1st. So that those negotiations will be happening. The 11th hour negotiations will be happening a week from today. Both parties still do seem to be pretty far apart on their priorities. And we're getting more and more signs now that this is becoming more and more likely to happen. So can you talk about this from an investor standpoint, Jurrien? Can you talk about whether government shutdowns historically have the ability to really sidetrack markets, and how concerned about this are you? How much of this is on your radar right now?
Yeah, so whenever this happens, of course, it becomes top of mind for many investors, and they're wondering, what does this mean? And we've had many near shutdowns, and we've had a few actual shutdowns lasting from 1 day to 34 days, I think was the longest one. The markets tend to look past it. They tend to look at it correctly, in my view, as political theater, not to diminish the severity of what happens, but our Social Security checks don't get cut. It's sort of people get laid off working at national parks or other government jobs, but then when the government reopens, they get paid in arrears, and the economy sort of picks back up. And so the market is focused on long-term issues like earnings, the economy, growth, interest rates, monetary policy, and government shutdowns, even though they can obviously be very disruptive, especially if you're working for the government, they tend to be short-lived and they tend to be resolved because basically, you can argue about money that's already been spent because this is essentially about deficits and the spending of that. There's not really a lot you can do, and so eventually these shutdowns do get resolved. It might be a game of chicken down to the wire, but the market tends to look through these things, and I suspect that it will do so again this year if we indeed get a shutdown.
All right. Well, you mentioned the markets tend to focus more on monetary policy, and that is exactly what we want to focus on today, Jurriën. So let's bring Jake in now to talk about last week's rate cut. Again, the first rate cut in 2025. Jake, I know you and your team look at the potential implications of financial market trends, macroeconomics, policy changes, and you use all of that information to help inform Fidelity portfolio managers and investment teams. First of all, can you talk about what a 0.25% cut tells us about the Fed's focus right now and what it tells us about how concerned the Fed is about the labor market versus inflation, its dual mandate, and which part of that dual mandate it's more concerned about right now?
No, absolutely. So it's really the dual mandate you focus on. The Fed always talks about its dual mandate, and it's clear that inflation has been going higher. So if they're focusing on one side of the mandate, it's not inflation, it's the labor market. And you've seen pretty weak payroll growth over the last 3 months. Many of the indicators that we're following here at Fidelity, looking at the payroll, the labor market in general, have been weakening. Doesn't mean everything is falling out of bed and not really recessionary, but they have been trending lower. And so it's clearly the labor market that the Fed's looking at in terms of why it's cutting rates right now.
And let's talk about what this means for Fed monetary policy going forward, Jake. History shows us once the Fed starts cutting, then a rate cutting cycle usually follows. We did get a viewer question about this. Thank you to Mike, who wrote in when he registered for our show last week. Just a reminder, if you register for our show, you can pose any question to our thought leaders like Jake and Jurriën. And he wanted to know about this. He said, where do you see interest rates going? So what do we know right now about the Fed's plans from here, Jake?
Yeah, so the Fed's very data dependent. They say that in their statement. What we know right now, and to your point, it's when the Fed feels that it's in the need to start cutting rates, they will likely continue to do so. Historically in the past, you've seen many rate cutting cycles be about 3 cuts, so about 75 basis points in easing at a minimum. And if things continue to kind of tread water and the labor market's not doing great, they continue to go more. And so, as you can see here on this dot plot, this is basically what the Federal Reserve members, the FOMC board members, are basically trying to estimate with their best guess individually about where they think the Fed funds target rate is going to be at the end of this year, next year, and beyond. And as far as this year, it looks like their Fed's probably going to cut interest rates about maybe 2 more times, 1 to 2 more times. That's basically, what the market expects as well. But after that, it gets very, very, very uncertain because we don't know right now what the economy is going to look like in the middle of next year. So when you look at these dots further down, that's why you have so much more dispersion across the members. But basically, it does appear that the Fed is going to continue at least to cut 2 more times this cycle, and more beyond if things like if labor markets stay weak and inflation doesn't go up too meaningfully.
And like you said, in agreement with what the market is pricing in. I want to take this discussion a click down a little bit. So you talked about the fact, Jake, that the Fed is going to prioritize the labor market part of its dual mandate right now over inflation. Does that mean the Fed is concerned about the possibility of a recession? And does that jive with what your team here at Fidelity is thinking right now? Does your team share the same view?
Yeah, so absolutely. So if you have rising inflation expectations, as the Fed has basically said in its SEP, it's basically a summary of expectations for growth in inflation and unemployment going forward. They're always concerned that their policies could ultimately lead to a recession. It's not in their base case, because if you look at where they expect unemployment to be at year end, it's just basically slightly higher than where it is today. When we look at the overall economy, it's not just looking at one labor market indicator like the unemployment rate or anything like that. We have a swath of different indicators that we look at to assess the most likely path of the economy. And right now, we think recession risks are indeed very low over the very near term. And with the Federal cutting rates, and you have also fiscal easing and other levers like that, that also provides us with the view that recession risks are indeed relatively low. So the Fed may be concerned about it by cutting 25, but 25 basis points isn't all that much. I mean, if they said they were going turbo cuts, 50, 75, or 100, that would be a bigger signal that they thought that there was something more meaningfully dire from an economic front ahead.
Okay, certainly.
I would just add to what Jake is saying that, like the fact that the Fed cut rates doesn't mean that they expect there to be a recession. I think probably the way the Fed is thinking about this is that they realized, they went to 5 3/8, a couple of years ago when inflation was highly elevated. The inflation rate is still above the Fed's target, but it's come down. And now the jobs market is, in balance, but softening somewhat. So, if I was at the Fed, I would say, well, 5 3/8 is really not justified because we probably need to be closer to neutral. And I think that's what the Fed is doing. So I think the Fed is adjusting, tweaking, if you will, rather than saying, oh my God, there's a recession. We're going to go all in on easing policies.
Tweaking and adjusting. That's certainly reassuring. Okay, Urian and Jake. So I did want to ask another question about what this might mean for long-term rates, Jake. I think a lot of investors are thinking about the last time that the Fed began cutting rates, which was actually this time last year, September of 2024. And at that time, we had a show about this, and we actually had our vice president of lending on the show. They're talking about mortgage rates. We saw the 10-year Treasury and mortgage rates rise after the Fed cut last year, which was pretty counterintuitive. This is all prolonging the tough dynamics in the housing market. So I know a lot of, potential home buyers are watching this very closely. Can you talk about what is happening with long-term rates this time around?
Yeah, sure. So if you focus on what happened last time around about a year ago, you had an inverted yield curve. And so short-term rates were higher than long-term rates back then. And so when the Fed was actually cutting the short-term rate, it didn't really have a material impact on bringing longer-term rates lower. In other words, the yield curve steepened and the market was expecting that. Now, about a year later, you've actually have a positively sloped yield curve. So long-term rates are higher than the short end of the curve. But there still is a risk, as you highlighted, that if the Fed does indeed continue to cut, that long-term rates may not actually come down and they could go higher. I could just give you a couple examples as to why. Because what matters for long-term interest rates, say like 10-year yields or 30-year yields, is the growth expectations in the economy, inflation expectations for the market based on where they think the inflation's heading over the long term. And there could be other factors like technical factors or concerns about debt. And so it's focused on just growth. If growth starts to stabilize and get better, that actually may mean that longer-term interest rates actually go a little bit higher because growth exceeds expectations. If inflation starts to exceed expectations, that could push long-term interest rates higher as well. So there's a lot of factors that matter. The short end of the curve is really dominated by what the Fed does, but the long end of the curve is really more of a function of growth and inflation primarily.
Okay, so there's still a possibility long-term rates could go higher. One of those factors that you said could affect that is debt. So let's talk about debt, because I know this is something that your team is pretty focused on. You've been keeping a close eye on the long-term implications of government spending. Is it within the realm of possibility that a new Fed rate cutting cycle could soften the impact of the growing federal deficit? If we do see longer-term interest rates fall, in theory, it could reduce borrowing costs for the federal government. And if that were to happen, could cuts really meaningfully chip away at the federal deficit?
Yeah, this is a big question that people are kind of wondering and really trying to get their heads around, because mathematically, if the Fed is cutting rates in the short term, then short-term interest rates in the form of treasury bills, the federal government will be able to pay a lower amount of interest on its debt. Mathematically, that is just seemingly like, okay, then why don't you just do it? Well, there's a lot of things going on, and a lot of that, what I'm trying to basically kind of assess is that it may be near term a good strategy, but kind of what we just talked to in your last question is, if ultimately the Federal Reserve pushes rates too low and the market starts becoming concerned that there's a lack of credibility with the Fed being able to fight inflation or other kind of factors, that could push longer term interest rates higher, which then would ultimately be a longer term hindrance to the interest. And so there's a lot of things happening going on. It's not as easy as just setting an interest rate and expecting that to kind of solve all your debt problems.
Wouldn't that be nice?
It would be nice. It would be nice, but it's a market-based system. And so I think near term, though, to answer your question, is it will help. Like it will help. It'll lower the interest on some of the debt. But at the same time, then we're paying less interest rate and lower interest rates down to consumers and pushing on, and providing people less money towards their savings. And so it may not necessarily be a good thing. So there's a lot of different factors there. And what we really have to monitor in terms of all the debt is, will there be enough buyers to fund the federal government? You're currently seeing Treasury auctions not have any failures. They're passing through okay. There's still foreign demand for Treasury bonds and Treasury securities and U.S. securities, despite that being seemingly a concern over the last 4 to 6 months. And so you're still seeing the demand as of right now. So at some point, these high deficits could be an issue. And this is something we are focusing on really intently. But in the near term, it doesn't seem to be a factor as of quite yet.
Oh, so it's something Jake and his team are pretty focused on. But Jurriën, how much attention are the markets paying to debt? Are they able to look past it? And will that continue?
Yes. I mean, obviously, this is the big issue. This is what our customers are asking about, very consistently. And I think what Jake was saying was that, there's basically no free lunch, right? If you're running a high debt level, which obviously the U.S. is doing, as well as many other countries, then, what role does the Fed play? Does it keep rates lower than is economically justified? And if so, does the yield curve then steepen? And if so, does that mean the Fed has to come in and use its balance sheet to try to keep the long end of the bond market in check? And if so, what happens then to the dollar, right? So there's all these little transfer mechanisms, if you will, transition mechanisms, where if there's something not right, it gets felt. But the stock market is seemingly fine with this. I think just from what I read, politically and economically, I think the government in Washington is trying to outrun the debt basically by growing the economy faster. I think that's what the One Big Beautiful Bill is about. That could boost earnings, right? It could raise rates, but it could boost earnings. It could boost inflation. So the stock market, I think, is okay with it right now, but in large part because the 10-year Treasury yield is near 4%, right? A year ago, 2 years ago, back in 2023, the yield was pushing to 5%, and the stock market does not like that. But near 4%, I think the market is looking at this and looking at inflation expectations that are embedded in the TIPS market, the Treasury Inflation Protected Securities market. And there the market seems to be looking at, 2.5% inflation as far as the eye can see. And the 10-year is at, 4.1 or so percent. And against that backdrop, the stock market really doesn't have much to worry about. But that's today, and we don't know what tomorrow is going to bring there. And so, what happens to the Fed, the next leadership of the Fed, and whether it becomes more political, there's a vast number of unanswered questions right now in terms of how this is going to play out.
All right, but it's more comfortable territory for the market right now, you're saying, Jurriën.
Yes.
And given the current economic backdrop and the environment with rates coming down, I think a lot of the audience out there today is probably wondering what that might mean for them in terms of potential opportunities when it comes to both the stock market and bonds and beyond even. So, Jake, maybe I'll pose this question to both of you, but Jake, what would be your answer to that, first of all, potential opportunities here?
Yeah, so risk assets, equities in general, tend to do well when the Federal Reserve is easing. So that's a positive. Jurriën alluded to that. Interest rates don't tend to spike up dramatically when the Fed's easing. So that should be like more of a stabilizer for bonds. But at the same time, there are risks out there. And Jurriën mentioned the dollar being one of them. And one of the key things we try to tell people is that, with there being no free lunch to any of this stuff, and that at some point something could unexpectedly go sort of sideways, then what you really want to do as an investor is stay invested, most importantly, but also be diversified. And so if the dollar goes down and you have more exposure to, say, non-US dollar denominated assets, whether it's in equities or bonds, that could provide a little bit more of a diversification benefit. And so if you're looking at your fixed income exposure and there's, say, more inflation, maybe having some inflation protection or some credit instruments, other types of bonds that do better in a higher inflationary period. So really the main lesson we're trying to get across is economy is in expansion, stay invested, unexpected outcomes can be there, so definitely stay more diversified to hedge some of those outcomes that may surprise you.
Yuri, same question to you. Potential opportunities in a lower rate environment?
I would echo what Jake says. The fundamentals right now for international stocks is the best I've seen it in years, and also with concentration risk in the U.S. market, the Mag 7, et cetera. It's a good backdrop to kind of have a bigger pond to fish in, if you will. So having the markets participate more globally, especially if the dollar does weaken, I think is a real opportunity for investors.
Bigger pond to fish in. All right, we'll leave it at that. And we did cover a lot today about what investors might be able to expect as we enter another rate cutting cycle. And we want to leave you with another resource on that topic, which we always like to do at the end of each show. So we want to remind you to bookmark fidelity.com/market volatility, where our partners at the Fidelity Viewpoints team have gathered the latest insights from our Fidelity thought leaders and investing ideas. You'll be able to read several articles if perhaps reading is more of the way that you learn there on that website. There's even a link there to a replay of this show in case you want to watch it again if you were watching it live and you wanted to watch it back. On behalf of Jurrien Timmer and Jake Weinstein, I'm Heather Hedges. Thanks so much for your time today. Great show to both of you guys. And remember to catch us every Tuesday at 2 Eastern. We'll see you next week. And don't forget, we're also available if you're on the go, wherever you get your podcasts. Take care.